So without further ado, everyone's talking recession. And as you can see from my range for 2023, it's a minus 0.5%. These are year over year numbers, understand? Minus 0.5% to up about 0.7, maybe even a little higher than that. The possibility to maybe go higher than that. Again, year over year numbers. The big thing to remember is, and again, this my base case is that we do have a recession in the back half. That's been our call for better than 6 months now. That there will be a recession in the back half of 2023. We had been saying that it wasn't inevitable. In recent weeks, enough dominoes have fallen, but I'll show you that in a second. Enough dominoes had fallen that I'm starting to doubt it's not inevitable part. Nonetheless, I think the bigger picture point here is that regardless of some people trying to compare to the great financial crisis, this is not the great financial crisis on a number of levels, not the least of which is, yes, there are some banks that wobbled, and yes, Credit Suisse needed a bailout. And yeah, that's the first time we've done those things as far as takeovers and rescues and emergency plans since the great financial crisis. But even some of that is not necessarily, it rhymes a little bit, but it doesn't necessarily mean it's exactly the same. And so one of the things that I want to impart to you as an audience member is to understand that every recession is different, or as we as economists like to say, if you've seen one recession, you've seen one recession. Each of them has different drivers, and there are different factors that cause them. Additionally, there's different causes to hasten the way out, the recovery. So again, the drivers and what have you are different. Again, there are some similarities in some of the pieces, but they're not all the same. Additionally, we have a recency bias as humans, and so people are wanting to say, well, the last recession was the pandemic. And well, the one before that was the great financial crisis. And I would tell you that the great financial crisis was a recession, but not every recession is the great financial crisis. Nonetheless, I think that the take-home point here from this slide is we've had a step down in growth that is going to happen whether we skirt a recession or not. I again think that we have a recession in the back half of the year, mostly because of tightening financial conditions, which I think in the past couple of weeks are going to get even tighter, because banks are going to tighten up with some of this liquidity drying up. So again, that's a natural thing. It's also not the end of the world. We do, in economic terms, move in kind of boom and bust cycles. And from just thinking about it as a business owner, it's a lot of decisions are kind of binary. That said, many other decisions aren't. Things like hiring are not binary, so it's not all or nothing. Sometimes there's kind of in between sort of situation. So keep some of those things in mind. Again, we are going to have a step down in growth, whether we skirt a recession or not. I don't see the hallmarks of something that's going to be deep or lasting, unlike some of these folks that are putting things out on the inner tubes, saying about how, the end is near and we're going to ditch the dollar and all these other kind of doom and gloom sort of things and the zombie apocalypse. So I don't think you have to worry about the zombie apocalypse just yet. That said, the ditching the dollar, among other things, and going to cryptocurrencies, one of the banks that failed was Signature, was a big crypto related bank. And we've seen that cryptos have been hammered here as things have gotten more volatile. So if they're some sort of alternative from the dollar, they don't really seem like they're performing in that fashion. You'd be better off buying other things. Nonetheless, again, part of the reason why we're saying we're not in recession yet is the big four recession indicators that the National Bureau of Economic Research uses to measure these things. This is indexed data. You do see on the far left of the slide here is the pandemic. So you see that pandemic recession. And when you see these indicators moving in tandem down sharply in the case of the pandemic recession, it's quite easy to see, hey, that's what a recession looks like in this data. And as you can see now, we're not seeing that. Production did come down over the past few months, but it does seem like it's stabilized for the last two. That's no guarantee that it won't move lower. And I would point out that all four of these, and I'll go through that in a second, but all four of these are coincident or lagging indicators. They're not leading indicators, so womp womp, but I'll get to that in a second. In the case of these four, production, that's industrial production. Employment, this is total number of jobs. So it's not the unemployment rate or some of these other things, it's total number of jobs. So we are back above, and we have been for a while now, back above pre-pandemic levels. Real consumer spending, which means it's inflation adjusted, and real incomes, personal incomes, again, also inflation adjusted. And as you can see from the spending and income numbers, incomes have sort of flattened out. We haven't seen, particularly for hourly employees, the continued push up in wages that people were worried about. It's kind of flattened out, but we haven't seen a dip there, which has helped with on the spending side. So spending continues to climb. Yes, some of that is because of inflation, but nonetheless, we are seeing those things continue. And then more importantly, the employment piece, we're seeing that companies are still adding jobs. And yes, you're hearing about high profile companies like Amazon yesterday announcing another 9,000 job losses. It's important to remember that they have been largely, this isn't to say that it won't extend to other industries, but they have been largely concentrated within tech. And tech had an incredible amount of hiring that happened, particularly early in the post-pandemic period. So taking, again, not picking on them, just picking on one of them in the case of Microsoft, announced a 10% job reduction and what have you. Even after those reductions, they're still 40,000 employees higher than they were pre-pandemic. And that's just, 2.5, 3 years ago. So again, a tremendous amount of hiring. Some of these companies essentially have positioned themselves that the pandemic sort of trends of online and doing everything online were going to continue. And obviously that wasn't the case. And as things have opened up, and I would say generally normalized, we're seeing things move back to service oriented and away from goods. So you can't really ship getting your teeth cleaned and things like that. And it's important to remember, we talk about the consumer being more than 2/3 of the economy. Well, a full quarter of the US economy is healthcare services. And again, this is going to the doctor for bumps and bruises, stitches and knees, but also again, getting your teeth cleaned and those sort of things. So those things aren't remote jobs. Those aren't things that you could ship over the internet. Yes, you can use technology, but you're not going to replace those jobs, at least in the near term, until that chat GPT thing gets all ramped up. That's a joke, people. Another point, my famed stoplight. So these are typical recessionary indicators. And as you can see, the vast majority of them are red. A couple of them are yellow. The employment ones are the ones that are hanging in there. Now, again, employment is lagging indicator with the exception of weekly jobless claims. But weekly jobless claims, and I'll show you a chart of that in a second, weekly jobless claims are not showing signs of stress. And it is typically one of the areas where you do see stress, particularly when you're seeing job losses. So what appears to be happening is, and when I talk anecdotally to companies and businesses, large and small, is that many of them are hoarding employees. Even though you're hearing about job losses in some of these headlines, they're still generally hoarding employees because they look through it and they say, hey, it's going to be a brief sort of thing, much like I'm saying that it's going to be a brief, maybe it's 6 months of slow, sluggish sales or whatever that they do. And they say, it took me a year or two to replace some of these jobs after the pandemic. Why would I let people go if it's only going to be slow for 6 months to have to take another year to bring them back, and then I'm behind the eight ball again. Oh, and by the way, I'm going to end up having to hire them back at higher wages. So particularly small and medium-sized businesses, they're, again, just anecdotally talking to business leaders and C-suite folks, that they're very reticent from letting people go just because everyone says things are slowing down. They're still seeing sales hanging in there. They're maintaining some of their staff. And again, proof being in the pudding here is that they're not showing up in weekly jobless claims, which again, I'll show you here in a second.
Hey, Mike, real quick, I got a question.
Sure.
Your unemployment rate is U4, not U6, correct?
Of course.
Okay.
Yeah, but U6 is, they've been moving in tandem as well. U6, for those that don't know, is the broader view. The U3 is the traditional unemployment rate that's quoted everywhere. But if we aggregate the leading indicators, as the kids say, never have I ever, this red line on the slide, never have I ever not had a recession, when the leading indicators on a year-over-year basis are down more than 2.5%. Well, we're down 6.5% now. So again, there's enough of these dominoes in leading indicators, including some of the things that are sales related and new orders and those sort of things, that point to a recession on the horizon. I mentioned weekly jobless claims. This is a chart of weekly jobless claims. It is truncated, so understand that during the pandemic, as I have notated there in red, it spiked up to over 6 million jobless claims because of the shutdown. So that was unprecedented. So it goes literally off the chart. That said, if we look at where we are now, and we're hanging in the 190,000 to 200,000 per week, we're running below the pre-pandemic 3-year average and longer term averages to that. And we're actually hovering quite close to the 53, 54-year low, which is literally the all-time low as far as claims. So yes, there are job losses that are being announced. And yes, there are other facets, including in some of these cases, because they are larger companies, so somebody like Amazon letting people go, there is some sort of severance. So there's a lag there, but we're not seeing folks showing up asking for unemployment. And typically the unemployment office is the second place that people show up after they lose their job. Of course, the first being they went to the bar to talk to their friends. Nonetheless, let's switch gears and talk about inflation discussion. Some of the core prices are continuing to move higher. On the left side here, showing you the month-over-month numbers, the longer term view, if you will, the annual change or year-over-year change numbers are on the right side. And as you can see, again, they've peaked and are moving lower. Certainly a big chunk of that headline number, the truest purple line, has been food and energy, predominantly on the energy side. I'll hit that. We're seeing food has also rolled over and moving lower. Nonetheless, overall trend is that we're moving lower. That said, we're not going back down to pre-pandemic levels. And I think that's another one of those take-home points walking away from this, is we are going to see a step down in growth that I mentioned earlier. But the other one is that we aren't going back down to pre-pandemic levels, and I'll show you some of the reasons why. One of them is food and energy. This is gasoline prices. This is U.S. averages. We peaked a little bit over $5, again, national average. I know in some parts of the country, particularly places like New Jersey that make you, have someone pump your gas, the gas prices are more. But certainly if you go to the West Coast, it is still probably a $5 gallon of gas, and that their peak numbers had a 7 in the front of them, depending on the area. Nonetheless, we've seen that pull back for a number of factors, one being production, but the other one being that some of it was generally just speculation on world markets, that taking Russia out of the global mix as far as suppliers, and they are one of the largest suppliers, But let's not forget the US is the largest global producer of crude oil. That's no caveats. Yes, people talk about the Saudis. The Saudis are the largest exporter, but they are not the largest producer. The largest producer is the United States. And up until recently, we weren't exporting, but in recent years, we are now exporting. So part of that view is that the US was going to have to export a whole lot more, and that pushed up price here domestically, but also pushed up prices globally because of that worry about the Russians. I'll get to that piece in a second, but also wanted to touch on the food piece. It is a large piece, so let's not forget that food does have an impact, but it does have a bit of a double whammy, if you will, because of energy prices. The first being is that many of the fertilizers that are used within food production, not just in the US, but globally, are derived from energy, particularly natural gas. So there's that piece. The other side is that, of course, running tractors and what have you are done on oil, crude oil derived product generally. Most of them are not electric or EVs or any of those sort of things. So you have that. And then the third piece is you drive those goods to market or transport them somehow, again, largely using crude oil. So there's this double whammy effect of it's an input for them and then carrying their goods to market, of course, as well. That said, similarly, we've seen things peak and move lower. On the left side, you're seeing the kind of breakdown between food, the total, which is that truest purple line, the green line, which is food at home. That peaked a little bit later. And then food away from home. Most of the food away from home was the increase in hourly wages for employees. It was less about food cost, particularly for larger operators. But again, that's a challenge moving forward for operators. But nonetheless, we have seen food costs spike depending on the product. In recent months, it has been egg prices, and everyone's aware of those. But most of that had to do with avian flu that went through the flock, killed more than 37 million chickens. And if you don't have chickens, you can't make eggs. So there was a big scarcity there. On the right side, we're seeing the producer price size. So these are wholesale prices for food overall. Finished consumer goods is the truest purple line. The lighter line is foods for export. So these are like bulk things. So think wheat, rice, corn, those sort of product. And we did see a dramatic increase after the beginning of the pandemic. There was also another little bump up that happened early in first quarter of 2022 because of the Russian invasion and worries about particularly wheat supplies globally. But that's moved through, and they've made an agreement to allow the Ukrainian wheat crop to hit global markets. So that's helped as well, but still elevated. Nonetheless, we've seen that peak and move lower, but still higher than pre-pandemic levels. So again, coming back to this theme of inflation is peaked and moving lower, but it's not going back down to pre-pandemic levels. As far as consumer inflation, again, that peak is quite obvious when we look at the numbers. That said, there is a wide range of outcomes that can happen as we move forward. Very quickly on this chart, the month over month number, which has been running in the, call it up 0.2 to up 0.4 per month. There's a couple that have been a bit larger than that. During 2021 and 2022, we saw up 1% sort of numbers. Those are very unusual and likely not to be replicated. Again, large chunks of those moves were crude oil related. I'll get to that in a second, but overall, we think that things are going to settle down and move lower. My forecast is for it to be about 2.2375. So round it, call it 0.3 on a monthly basis. That's higher than the pre-pandemic 3-year trend or even the 10-year trend. it is closer to the longer term trend, like the 20 or 40-year trend. Nonetheless, I think it's probably going to trend higher and will continue to trend higher on a monthly basis, which as we spin that forward, if we just say, hey, it keeps averaging that up 0.3-ish number for the rest of the next 12 months, you get a 3 or 4 handle on there. And this part is not predicated on a recession. If we have a recession in 2023, obviously that would accelerate some of these numbers lower. So again, from an inflation standpoint, I think it is a little bit more of a palatable view. It's running hotter than it needs to be. When we start talking about core, which I will in a second, you start seeing that it's still higher than it needs to be, or that we're comfortable with, or certainly what the Federal Reserve is comfortable with. But nonetheless, it is naturally moving lower. And as we move through the spring months here, particularly, so the March, April, May numbers, especially, we're going to have some of those 1% up 1% per month numbers drop out of that 12-month window. And we're going to hit an air pocket as we move down. So that's part of what happens here in 2023 as we roll forward. That said, we get to core inflation. This is a little bit different view of core. And I kind of drop it into 3 buckets. All other sectors, the majority of that is housing, which I will talk about in a second. The truest purple part of the bar is the reopening sectors. So these are things like transportation services. So think airlines and those sort of things, but also rental cars. So there is an auto component there as well, recreation services, commodities, apparel, a whole bunch of other things that were really specific to the reopening. And we saw some mismatches in some of those supply demand cycles that we anticipated they were going to be a whole lot higher. And if I pull this back into 2021, you'd see that these were adding, 2% plus on a monthly basis. That's settled down. It has increased a little bit more, particularly as we moved here into 2023, partly because of some of the used car pricing and new car pricing impacting rental cars. Nonetheless, that one seems to be evening out. The larger part of the bar, which is that, again, all other sectors, we're seeing that increase as well. Most of that, again, is housing, which I'll dive a little bit deeper here. But the one that really was adding a lot, and you can see that in the left part of the chart, is new and used vehicles, particularly used vehicles. Very quickly here, most people know this story. Nonetheless, you had shutdown in 2020 production. You had a shutdown again in 2021 production because of the semiconductor shortages. So over a 24-month period, you had 16, 17 months of production, and no industry can really satisfy demand, let alone higher demand, with 17 months of production, but 24 months of sales. That's just a too big of a mismatch, particularly when you're talking about 15, 16, 17 million units on the new vehicle side. Nonetheless, we're starting to see that, particularly on the used side, that used vehicle prices are coming down, not just on a year-over-year basis, but also on a monthly basis. It does matter about what type of vehicle you're talking about. Nonetheless, particularly some of the SUVs, but also luxury sedans have been the hardest hit here in recent months. But if we pull this back to prior years, you would see normally new and used car prices, they're negative on a monthly basis, particularly because used is much larger than the new side. So I mentioned that 16, 17 million units, that's on the new side. It's 35 to 40 million units on the used side on an annual basis. So again, used car prices overall tend to be deflationary because as cars age, they're not worth as much, they're worth less. So they they continue to step down. So we're starting to see some of those longer term trends work their way through. And from an inflationary standpoint, this is starting to be a drag. Vehicle prices are starting to be a drag, which they naturally or typically are. Wholesale prices, which tend to lead consumer prices, have rolled over a lot harder than the consumer prices here in the past few months. Again, on the left side, showing the month over month numbers, on the right side, showing the year over year or annual change. Again, if we look at it, X food and energy, so looking at the core numbers or at the overall, again, you still see a very similar sort of situation, that particularly on the good side of the economy, with things shifting back towards where they should be, a more natural state of services being larger than goods, that we're seeing that prices are starting to move down. Additionally, we're continuing to see that supply chains, for the most part, are getting back to normal. There are some pockets where it's a little bit still pinched, including on the semiconductor side. Nonetheless, we are seeing overall supply chains are coming back to where they should be. I did mention that the largest part of that core inflation piece is housing. The biggest piece within that is rents, particularly, apartments and what have you. And we've seen a big bump up on the right side. You see the rent index. These are month over month numbers. The dotted line there is the average going back to 2015. And on a monthly basis, they tend to creep up about 0.4. We dipped negative here at the end of 2022. It's bounced back to being modestly positive, and it's likely to stay modestly positive. But more importantly, on the left side, you see total rents, and you see that they escalated higher, but they seem to plateau, and they've just been grinding higher ever so slightly, again, by that 0.2, 0.3 sort of number here in recent months. But again, not escalating the way they were in 2021 and the early part of 2022. And we expect that rental prices are going to continue to kind of flatten out here. Don't expect rents to fall dramatically. That's not typically a thing. Even during recessions, you don't see rents typically falling dramatically. It was very atypical to see during 2020 rents declining. Some of that was landlords, particularly smaller landlords, giving folks a break because of the pandemic, letting people be flexible either with payments or skipping some payments because of the pandemic. But again, those are very atypical. Even in a recessionary sort of environment, we don't expect to see a drop in rents going forward. But if you think about rents, here's the thing that people have a tough time wrapping their head around. And that is, hey, rents are dropping. Why aren't we seeing that pull through into those, consumer price index, the CPI sort of numbers, the inflation numbers? And they use a weighted average approach. So when you think about it, as these things are starting to plateau, that's only 1 month's worth of data. And they try to do this weighted average approach where they're basically dropping off 1/12 of the number. So you're going to need more than 12 months of flatness or plateau, as we have on the left side here, to really work their way into those numbers. That said, we already see from private data, like what we're looking at right here on the screen, is that it's already happening and has been happening for months, is that we don't see a scenario where rents are going to get dramatically tighter the way they did in 2021 and 2022. They're likely to be more like the long-term trend, which is, again, a little more supply and demand driven rather than because of the pandemic. New housing activity, because of what the Federal Reserve did in increasing rates during 2022, crushed new housing activity, particularly when we look at the units and starts, as far as those numbers. But what we have seen here in 2023 is that there's been a tick up here. Again, still very depressed, particularly on the bottom left here, looking at the traffic numbers as far as prospective buyers. There has been a bit of an increase off of the lows. That could be some bargain hunting. We've also seen that some builders have been offering discounts and other things, free upgrades, get the granite or whatever, or all stainless steel appliances, those sort of things, to try to move units that they had existing. That said, there isn't a bubble within the new home building sector. There isn't the speculation that happened during the 2005-2006 timeframe. And again, the housing bubble popped in 2006. The recession started at the end of 2007. Most people think that the onset of the housing bubble being burst was in 2007 with the recession, but it was actually more than a full year before that. So we've been wallowing here for a good 15, 16 years spread as to where things are at. And I would argue that we're a bit underbuilt. And when you look through some of the data I'm going to show you, you'll see what I'm talking about. But even in some of these numbers, like the new permits, which is the top right, you see that there's been a tick up there, but this is total building permits in units. When we dig a little bit deeper here, and again, this is the same numbers, but blown up, but I'm adding two series onto here. One is single family permits, and you see that that's the lighter purple line, that one's continuing to go down. There was a little bit of a tick up here in the last month or so, but nonetheless, it's down dramatically, not just in the last year, but is below pre-pandemic levels. But you see the green line, which is multifamily. Multifamily is not just up on a year-over-year basis, it's also substantially above pre-pandemic levels. Yes, the single family is the much larger slice of the pie, but they're driven by different drivers. So that those housing affordability numbers that you're hearing about, and I'll show you a slide on that, but housing affordability is being impacted. Some of that has to do with price. I'll touch on that more in a second. But nonetheless, if you can't afford to buy a house, you need to live somewhere. That does drive people back towards multifamily. So again, there's a bit of a yin yang sort of scenario or relationship between single family and new supply and multifamily. So again, there's been a very favorable environment for multifamily. It's likely to continue even with higher interest rates, because again, higher interest rates means higher mortgage rates, and that means that it impacts housing affordability for most folks. I mentioned earlier that we've been underbuilt, I think massively underbuilt relative to household formation. This here is a bespoke slide that I've been using for several years now, but it really illustrates this point. And this is excess housing starts above household formation. So on a typical year, and again, going back to 1959, so very long term, you see that we typically build about 300,000, maybe 320,000-ish houses more than household formation. And so those numbers end up giving you somewhere in the ballpark of, again, long-term average, about 1.5 million total units. So that's single family and multifamily, but about 1.5 million total units. Certainly there's a geographic component to that, and all of them are different. But obviously the vast majority of new building, particularly in the last 25 years, has been in the South and less in the Midwest and the Northeast. That's likely to continue. So again, there's some mismatch there. And depending if you're trying to build a house in a place like Cleveland or Detroit or Buffalo or, those sort of places, yeah, they don't build as many houses there. But if you're in Florida, Texas, Georgia, the Carolinas, yeah, you're building quite a bit. And that trend is likely to continue. But again, nationwide numbers, we build about 300,000 more than household formation. That's a typical thing. I did highlight there in 2020, there was a big drop in household formation of about 1.9 million drop that happened. So it does look like, wow, there was a big spike in building there, was that, but that was this excess housing starts. So you had a big drop in household formation. There's several reasons for that. Nonetheless, when we look at the last roughly 14, 15 years, since really 2009, we've been at a deficit we've been underbuilding by 117,000 units per year. So if you total that up, that's a deficit of ballpark 1.6, 1.7 million homes over the course of that period. And again, that's just the numbers that you haven't built in the excess. You haven't building enough at all in a lot of these areas. So any of the hotter markets, and I'm thinking of places like Raleigh, North Carolina, or certainly Austin, Texas. It's really hard to find housing in these places, not just single family, but also multifamily. So again, there's just not enough building going on relative to the household formation that continues. I mentioned affordability, so very quickly, the light purple line here is the 100. This is an index, but generally what that index is about is that you're saying what is the median family income and how much can they afford based on the median price home and of an existing, assuming that they put 20% down and that they're using about 25% of their gross income for that. So what are those affordability numbers? It's definitely being impacted by higher rates. Yes, that's part of it, but it's also higher home prices. Home prices on average, again, nationwide, are still up about 26% above pre-pandemic levels. And again, that's nationwide. Some areas like the Atlanta area, but also certainly on the West Coast and other markets, these hotter markets, certainly these Texas markets I mentioned, but also the Florida Peninsula, among other areas. They were up a lot more than 20 something percent. So again, you're seeing a challenge there. This is likely to continue for a while. This challenge of single family affordability. So again, that's one of those reasons why I think that multifamily, as we push forward, not just in a sluggish recessionary sort of scenario, but also into 2024, 2025, 2026 sort of things, that the next few years at the very least, there's favorable environment for multifamily. So here's the housing part. I do highlight in red there the US 20 city average. This is the 3-month annualized. We've seen a bit of a pullback here, but your mileage may vary. So it really depends on where you're at in that 20 cities. And I'll really highlight it here is that you've got a number of them, particularly some of these Western markets, but also a couple like Dallas that and Tampa that fall in there. But places like Vegas, Phoenix, San Francisco, Seattle, they had blistering numbers where they were getting, 30 to 40% increases depending on the city. And parts of Vegas, prices are still up 30 something percent, even though they've been falling fairly dramatically here for the last 6 to 8 months. Again, there's just not enough housing stock in those communities, particularly in the location in the right parts of town with good schooling, et cetera, that there's just not enough housing given continued influx of or in migration, as they call it, of people moving in. So they had big pushes up in price. Now that things have cooled down, and on the existing side, we've seen existing home sales down 12 consecutive months through February. So they're getting their teeth kicked in. But some of it is a give back from some of these big increases that happened. Nonetheless, even with those increases, prices are still up 26%, as I mentioned. So we're not going to see housing prices and housing costs in general, which again feed into those consumer prices, coming down in a big way. So let me wrap it up with where I started. I think we're landing, whether it's softish or not, I don't know that it's going to be too hard of a landing. It's certainly going to be a landing, though. Landing being a recession, that's a euphemism for a recession. Again, a recession is probable. It's not a guarantee, but nothing in life is. So there are some paths through. That employment dynamic that I mentioned of hoarding could be one. Nonetheless, womp womp. I think that inflation does stay elevated for a while, and that's going to be several more years because of this housing dynamic, as I mentioned. And again, it is the largest thing within that basket of goods that people spend on a monthly basis. Most of your biggest spending for people is housing, shelter, whatever way you want to put that. Lastly, I would say is expect more cross currents within the data. So you're seeing some good data like employment and other data that doesn't look so good, housing, among other things. And then inflation staying hotter, among other factors that, again, you're going to see some of these cross currents continue to work their way through. Even with the recession, expected to be more of a gradual, slow dance into recession. I think that credit is tightening because of some of the things I mentioned earlier, but not the least of which is the increase in rates that's happened. So that's my story. I'm sticking to it. We have some time to go through questions, right?
We do.
Yeah.
So if you guys have questions, feel free to ask, or you can use the chat and I will read them.
Yeah, this is Jeff. I was curious. It seems to me that a lot of the spike in prices was due to kind of almost a perfect storm of things in the supply chain rather than interest rate related stuff. And I'm not sure that the Fed is really having the effect as much as those things are kind of churning through the system. And we had the semiconductor shortage, we had supply chain problems in China because of COVID, we had COVID problems here, we had port problems. I was just curious about your opinion on that.
Yeah, so Jeff, you hit the nail on the head, and I would take that euphemism a little farther. The old saying of the guy with the hammer, every problem looks like a nail. Well, in the case of the Fed, their hammer is interest rates. That's all they got. And their way of correcting or fixing, easing prices is to hit the easy button. Well, for them to hit the easy button, they're not going to be as blunt as Mike. Their easy button is to slow things down, cause a recession. And typically, as we're seeing here recently, is that as you increase prices, increase interest rates, it causes financing prices to go up. I didn't delve into that much in the presentation, but nonetheless, you guys get it, that credit cards having a 20 on the front of them for your monthly finance cost, just to get a 20 for an annual basis, that means you're paying 1%, 1.25%, 1.5%, depending on your card in financing costs per month. That has a real drag, and it is cumulative. So in the immediate term, Jeff, that doesn't have as much impact, but it is cumulative, and it will, I think, lead us to a recession or the easy button, if you will, of correcting some of that stuff. But yes, it wasn't the Fed that caused it. It wasn't financing that caused it, but it is rates that will cause a recession to sort of reset things. It's not a pretty process, but it is the best that they've got. And again, that's the only thing they have is that hammer. Good question, Jeff.
Thanks.
So Mike, you brought up the home price chart, right? And kind of the different cities. Where does most of the folks on this call are in the Philadelphia area? Where does Philadelphia fall on that chart?
Yeah, so Philly has a bit of a unique situation. So most of the areas that are, Midwest, Northeast, you tend to have out migration, but the Philly area, much like the Boston area, I think, and certainly DC, is you still have people moving in, and so in migration from other parts of the country, because of the businesses that are in the area, plus some of the other factors, livability, things to do, all those, it's a cool city, if you will, that there's still inherent reasons why you want to live in Philly rather than some other places, that are largely industrial. So again, I've picked on Cleveland. I'm originally from Cleveland, but places like Cleveland and Buffalo and Detroit, they're not building as many cars. So if you had a manufacturing related job or somebody that was somehow loosely related to manufacturing and those jobs go away, you're like, why do I need to stay in Detroit? Philly doesn't have that sort of dynamic. It's not tied to one industry. The other thing I would say that Philly has, that it's an inherent stability because of this diversity of industries. So is it financial services? Is it education? Obviously, there's great universities in the Philly area, so that's inherently stable and it's not boom and bust. Yes, there's not as many kids going to school compared to maybe 2 or 3 years ago, but even if we look at 5 or 10 year numbers, there's more kids going to school. So those sort of things help. The other thing is when you have good university, it really does feed upon itself. And so you look at some of the towns like a Pittsburgh, but also a Philly that have good universities. After kids get out of school, they tend to stay in the region. They're highly educated. They tend to start businesses. So you have some of these, again, good dynamics for building and sustaining and really expanding a communities that I think Philly has a good mix. But again, it's not dependent on one industry. So it's not like if you look to your south a little bit and you look to somewhere like in Delaware, you're like, well, it's all financial services. And well, when financial services has a downturn, they get hit really hard because it's really concentrated in one industry. And again, Philly isn't one industry. It's a lot of different industries. There's also a big service component as well. But again, I think the diversity of businesses that are in Philly help to prop it up again, with one of the big cornerstones being education as well. And
good.
healthcare. And healthcare is one of the biggest employers in Philly as well, with the hospital systems and what have you.
And it's got to be one of the highest concentration of law firms as well.
That helps. Although, again, relative to its size, it's probably in line. Boston has a high concentration. New York has a high concentration. DC is crawling with them, so it's not higher than DC. But most of and I would say Philly's a gateway city. So most gateway cities, like in Philly's size, kind of top 20 cities, they have a high concentration because, again, when you have a lot of knowledge-based work, you tend to need a lot of attorneys and what have you to support those industries because businesses need whether it's contracts or other things, you need legal supports. But yeah, Kevin, that's a great point. And again, that they tend to be more stable. Of course, they're high income jobs. The other thing that that happens that a lot of people have lost sight of is those are also in-person jobs. So yes, you can do some virtual meetings and what have you, but people don't pay you $1,000 an hour to be their attorney and not meet in person. That's not a thing.
I have a question related to the unemployment rate. You spoke a little bit about employment hoarding, and we know that a lot of the baby boomers are starting to mature and leave the job market. And I was wondering, in that calculation, as we're looking at unemployment claims, is there ever a comparative to the total number of individuals who are available to work, or is there a way to measure that? I'm just wondering if we need to shift that measurement a little bit.
So that's the labor force participation rate, which is basically your total number of people. We monitor that has been sliding, partly because of what you mentioned. But the thing to remember is that the majority of the baby boom generation is out of the workforce already, and you really just have the youngest tranche that were basically into the early 60s, born in the the early 1960s left in the workforce, but for the most part, most of them are gone. We did see a sizable acceleration, whatever way you want to put that, of people dropping out of the workforce that were older workers, because look, on a human level, the pandemic was a seminal moment, and people really looked at, do I really need to work? Am I going to be a millionaire? I heard so many people tell me that as I was out and about and talking to people now in the last, year and a half that I've been traveling again for work, that people have told me that they retired or what have you. And they said, hey, I was never going to be a millionaire. I just said, the heck with it. I have enough money or enough, whatever enough is. And I'm going to stop working. And so that happened during the pandemic. Some of it have inched back, but looking at those labor force participation numbers, it's still lagging from where it was. We're still about a full percentage point lower than we were pre-pandemic. So again, Connie, to your point, lower than we were. But we come back, and my strong feeling is it's really about total numbers. So which I think is why the National Bureau of Economic Research looks at the total number of jobs, not percentages of whatever, because are there more people working? Because if there are more people working, certainly it means more output, but on the personal side, it means more income. And let's not forget it, that
Right.
in all these discussions about people making, wages going up, that's income for people. And when people have income, they spend it. That's how that works. They're working for a reason. They're not just working to hey, I just want to, do good things, and they pay me this money, but I don't really care about it. No, they buy things for it. They went to work for a reason. That said, the largest chunk of the workforce today, as far as single groups, is the millennials. They are about 42 or 43% of the total workforce. They are the largest slice of or cohort of the U.S. population. So a lot of people still think that the baby boom is the largest. They are not. It is the millennials. They are larger, followed closely by Generation Z, which is behind them. So these are like my kids and whatever. So these are the 20-somethings and the teens. They are larger than the baby boom as well. And they are beginning their way into the workforce. So as the Gen Xers like myself are we're aging as well, we're seeing that shift in the workforce that's happening with really this larger chunk. And over the next couple of years, that millennial and Gen Z is going to be much greater than 50% as we move in the next couple of years. So demographically, we don't have an issue. That said, we do have a how do we pay for healthcare for older people problem, but that's about Medicare and Medicaid. But we don't have a demographic problem per se, particularly within the workforce. Unlike our European peers, or certainly Japan and China, and China has an overall population decline that's happening. We're growing in the 1%-ish range. That's why we're continuing to see household formation, which I was showing some of those, a derivative of some of those numbers, but we're continuing to see household formation. We're also starting to now see again legal immigration increase. So as legal immigration increases, that's more people coming into the economy and into the US, which again continues to expand. So we don't have a demographic problem. And certainly don't have a demographic problem in the workforce.
Beacon is the premier executive networking organization serving the Mid-Atlantic region. To learn more, go to beaconforlife.org.